Hello everyone and welcome to Candriam's Coffee Break. Today we'll explore how shifting monetary policies, improved trade visibility, and political dynamics at the Fed are shaping our investment outlook for the months ahead. As we approach the final stretch of 2025, the global economy finds itself at an inflection point. After months of uncertainty linked to tariff escalations and a slowing US economy, financial markets are now finding comfort in three key developments: a more accommodative path for monetary policy, greater clarity on trade negotiations, and a significant political shift emerging at the Federal Reserve. As illustrated in the chart, expectations for the December 2026 federal funds rate have declined by 40 basis points since the end of July, reflecting growing conviction in a prolonged series of rate cuts. Simultaneously, the US yield curve has steepened in a classic bull steepening pattern, another signal that markets are pricing in a sustained easing cycle. This alignment has reduced economic anxiety, supported risk assets, and brought visibility back to short-term investment decisions. However, the Trumpification of the Fed introduces longer-term uncertainties that could reshape the future framework of monetary policy. Now let's look at global equities. Our overall positioning remains neutral, but with one important shift. We've upgraded Japanese equities to overweight. As shown in the chart on corporate profits and return on equity, Japan is benefiting from clearer global trade conditions and domestic momentum. Exporters gain from more predictable supply chains, while pro-growth policies and improving corporate governance fuel investor confidence. Elsewhere, we maintain balanced exposure, favoring mid-caps in the US and Germany, as well as resilient themes like technology, AI, European industrials, and healthcare. Turning to bonds, in Europe we remain constructive on core European duration and investment-grade credit, both supported by low inflation expectations and policy flexibility. We are more cautious on high yield and peripheral Europe due to political uncertainties. In the US, we keep a neutral stance on treasuries and continue to prefer investment grade over high yield. Finally, in emerging markets, we've upgraded both hard and local currency debt to slight overweight. Lower funding costs, improved trade visibility, and attractive yields are drawing investor interest back to this segment. Now to currencies, our view on the euro remains neutral, reflecting stable fundamentals. The US dollar, however, is underweight under pressure from easing Fed policy and political dynamics. Finally, we hold a positive stance on the Japanese yen, which we see as a strong play in a world of real rate volatility and increased demand for safe haven assets. Thank you very much for your attention. We will continue to monitor these events and adjust our strategies as necessary.